a separate video for buying puts as well as selling calls and selling puts. But in today's video, I want to focus on buying calls. Keep in mind the strike price is one of two key things to check when buying your call. The other one being the expiration date, which I'll also make a video about at a later time. Now remember, before you ever enter any options trade, please make sure you know how to close it. I'll pin a video in the comment section below where I show you guys how to close out of any options trade. So for today's video, I want to choose ticker symbol TSLA, which is Tesla. Now remember, buying calls is a bullish strategy. So in other words, you believe the price of the stock will go up. So let's say we're bullish on Tesla. We think the price will continue to go up here. Let's talk about which strike price we'd want to choose here. Now, firstly, Robinhood doesn't have any commission fees, so you can buy as many calls as you want and not worry about commission fees. The second thing, you can't be assigned when buying options. So in other words, you don't have to worry about being assigned or early assignment risk when buying options. That's only when you're selling options. So now that we've talked about those things, let's go into the options here. Let's quickly talk about the definition first of buying calls. So as you can see, right now we're on calls and we're on buy. So this is where you'd go to buy a call on whatever stock you're looking to buy a call on. So let me first start again by talking about the actual definition of buying a call, what it means to buy a call. So all these calls that you see here give you the right but not the obligation to buy 100 shares of the stock at the strike price, which is at the far left here, anytime before the expiration. So for example, if I buy this call here, this gives me the right but not the obligation to buy 100 shares of Tesla at the strike of 1,025 anytime before the expiration, which is April 14th here. Now here is the first thing I want to talk about, because some people believe that you're going to have to buy 100 shares of the stock. If you buy a call, you have to buy 100 shares, or you're going to be forced to buy 100 shares. That is not true. Like the definition mentions, the right but not the obligation to buy 100 shares. In other words, if you don't want to buy 100 shares, you don't have to. And so this leads me to the next point. Some people believe that to close out of your option, you're going to have to exercise it and buy the 100 shares. Again, that is not true. That's only if you want to buy the 100 shares of the stock. Most people, to close out of their option, will sell their option back to the market, sell their option back to some other buyer. They're not going to exercise it because most of the time, people don't want to buy 100 shares of the stock. Okay, so just keep that in mind. When buying a call, you have the right to buy 100 shares at the strike anytime before the expiration, but you don't actually have to. Most of the time, people are just going to sell it back to the market, okay, and close out, hopefully for a profit. So before I go further here and actually talk about the strikes now, let me introduce today's sponsor, guys, Webull. So right now you can get 5 free stocks valued up to $9,600 on Webull when you open and fund a new account by using my link in the description below, and also get $5 of crypto right now by completing a minimum $1 crypto trade on Webull. So again, I'll put a link to Webull in the description below, guys. Go ahead and check it out. So now let's actually get into the strikes here. Let me first start by talking about in the money versus out of the money, because I talk about that a lot in some of my videos, and maybe some of you guys don't understand what the difference is here. So when it comes to call options, in the money call options are going to be the options where the strike is less than the current share price. And so all the options below the current share price, which are these, are in the money. They're also going to be the more expensive options. Out of the money, it's going to be the options for calls. It's going to be the options where the strike price is higher than the current share price. So basically on Robinhood, there is this green line that separates the in the money and the out of the money options. For calls here, the out of the money options are the options above this green line. The in the money options are the options below this green line. And as you can see, out of the money options are also going to be less expensive than in the money options. So this leads me to another point that I see some people ask quite often. So some people believe that for you to make money buying a call, the stock must hit the strike first before you start making money. Right? So some people believe, for example, if I bought this call right here at the 1035 strike, some people believe that for me to start making money, Tesla must hit 1035. And after it hits that and continues to go higher, I'll start making money. That is not the case. Remember, there's a couple of different factors that influence the pricing of an option, like implied volatility, there's theta, but the one you should probably be more concerned about is delta. Okay, so let me just explain that here very quickly. So if I buy this call, I can start making money immediately. How? Again, it's going to be with delta. So if you go to the Greeks here, under the Greeks, you see a Greek called delta. Delta tells you how much the value of this option will increase or decrease by with a $1 increase or decrease in the price of the stock. So in other words, if I buy this call right now and Tesla goes up by $1, the price of Tesla stock goes up by $1, the value of this option will go up by delta, 0.2815. In other words, the value of my option will go up by $28.15. So if I buy this call and Tesla goes up $1 right after, I would be up $28.50. I'd already have a $28 profit. So you do not have to wait for the price of the stock to hit your strike price to start making money. You can start making money right away. And again, that's going to be because of delta. Now, of course, the opposite is true. If I buy this call and Tesla goes down by $1, the value of this option will drop by delta. So the value of my option will lose $29 right away if I buy this call and Tesla immediately drops $1. Okay, so I just wanted to put that out there. That's how these call options make money here. Now, of course, if this expires and your option is out of the money, then yes, it's going to be worthless at that point. If it's in the money, it's going to be worth something. So let me first start by talking about the in the money options here, and then we'll compare it to the out of the money options, and that way hopefully you get a better understanding as to what strike price you'd preferably choose here. So let's first start by talking about the in the money strikes. So like I mentioned earlier, when it comes to the options that are in the money, they're going to be more expensive, right? As you can see, for example, this call option at the $990 strike, $3,033. Versus if we go to an out of the money option, for example, at the 1050 strike, it's only $274. It's a huge difference, right? So in the money, call options are going to be more expensive. Now, in the money call options also have a higher delta. If we take a look at the same call option I just mentioned at the $990 strike, delta is 0.79. Right? And the further in the money you go, so the more down you go, the closer that delta is going to get to 1. Right? So in the money call options are going to have a higher delta. So what does this mean? This means that if I buy the in the money call option and the price of the stock goes up, I'm going to make more money faster, right? Because here, if I buy this call and Tesla goes up $1 right away, the value of my option will go up by $79. So I'd make $79 right away. As you will see with out of the money options, it's going to be a lot less. However, again, the opposite is true. If I buy this call right away and Tesla drops by $1 right away, the value of this option will also lose a lot more money. It'll lose $78, $79. So delta is going to be higher for in the money call options. However, in the money call options are generally less risky. Now, why is that? Because in the money call options, they're already in the money. Remember, when the expiration date comes, April 14th, right? If the price of Tesla doesn't move at all, if it stays at around the same price, the in the money options are already in the money. Since they're already in the money, that means they're going to be worth something. when these options expire. All the out of the money options are going to be worthless. They're all going to be worth $0. And so if you buy an out of the money option and the price stays the same, it's going to go to zero. You're going to lose 100% of your investment. However, if you buy an in the money call option and it's in the money when it expires, it's going to be worth something, meaning you're not going to end up losing 100% of your investment. That's why it's less risky. And in fact, another way to check that is if you take a look here, there is a column that says to break even. This tells you how much the price of Tesla needs to go up for you to break even. And guess what? As you go further in the money, you'll see that percentage is a lot less. For example, if I buy this call at the $960 strike, for me to break even, Tesla only needs to go up 0.1%. If it starts going higher, I start to make money. Well, what happens as we go higher and higher? This break-even percentage keeps getting higher and higher. And when you go deeper out of the money, guess what? It starts to get really high, right? 4.8%, 5.3%, 5.8%. So when you're buying out of the money call options, Tesla needs to rise, or whatever stock you're using is going to have to go up higher for you to break even. So that's why in the money call options are less risky because they're already in the money. If they're in the money, they're going to be worth something. And as you can see here, to break even, it's going to need to move a lot less than out of the money call options, right? So you can always take a look here at this to break even column. This is a very helpful column here to help you understand how much it's going to have to rise for you to just break even. So now that we've talked about in the money options, let's talk about out of the money call options here. So when it comes to out of the money call options, like I mentioned, they're going to be a lot cheaper, which is why most of the time people go for out of the money options versus in the money options. They're just a lot cheaper, a lot more affordable. And like I mentioned, delta is going to be lower. So now if we take a look at the $1,050 strike option, for example, delta is only 0.16 here, right? The delta on the in the money call option was like 0.75. Delta here is a lot lower. And so this means that if I buy this call right away and Tesla goes up by $1, I'm going to make less. I'm only going to make 16 bucks. However, if I buy this call and Tesla drops by $1, I'm also going to lose less. I'm only going to lose $16 here. So delta is going to be lower here. And so the other thing to mention, though, the big thing to mention here with out of the money call options is that they're going to be more risky. Why are they more risky? Because like I mentioned, Tesla needs to make, or whatever stock you're using needs to make a bigger move here for you to just break even. And again, we can take a look at that in the to break even column, right? If I buy this call right here, this will have to go up 3.6. Tesla will have to go up 3.6% just for me to break even. And by the way, this should be on the expiration date, right? So when this expires, Tesla would have to go up 3.6% for me to break even on this option here. Versus again, if I buy an in the money call option, by the expiration, it only has to move 0.4%, for example, with this one. So out of the money call options are going to be more risky because they do have to, this price of the stock will have to move a lot more for you to break even. Delta is going to be less as well, like I mentioned. However, buying out of the money call options, if those call options become in the money, if they get in the money, you will be making way bigger returns from a percentage standpoint than if you would have bought an in the money call option. And I can easily show you this by going over to option strat here. So let's go to tab here. Let's go to build. Let's go to long call. So let's first go ahead and just enter in the money call option. So again, we're using TSLA, Tesla. We were looking at the $990 strike, right? So here's our in the money call option for Tesla. So like we already mentioned, right? This is going to cost a lot more, $2,765. However, for you to break even, it's not going to have to go up that high. It's going to only have to go up 0.5% here for us to break even, right? Now, though, let's take a look here at the out of the money call option. So let's go to a new tab here of option strat. And let's do the same thing. Let's go to long call. Again, we're using TSLA. And then we were looking at the $1,050 strike. So this is an out of the money call option, right? This strike is higher than the current share price. So like we mentioned, right, this one's going to be cheaper. Out of the money call options are going to be cheaper, $234 here compared to $2,765, a lot cheaper. But like we mentioned, it's going to be more risky because the stock has to go higher for you to just break even, 3.9% here, as you can see. However, like I mentioned, if this out of the money call option becomes in the money, your percentage return is going to be a lot higher. So let's take a look here. So let's say, let me just actually go a little bit out here, and then let's go back to the other one here and let's compare it. So let's go a little bit far out here. And so let's take a look here. So if we take a look, let's say that Tesla goes up to $1,100, right? This is our in the money call option. So if Tesla goes up to 1,100, let's say on the 14th, this is telling me that I would make $8,235. But remember, we put up $2,765. So from a percentage standpoint, that would be a 298% return, right? But now let's take a look here if the same thing happens with the out of the money call option. So here's my out of the money call option, which cost a lot less. So if Tesla goes up to $1,100 by the 14th, that would mean this call option will now be in the money. And according to Option Strat here, I would make about $4,766. So yes, from a dollar standpoint, it's less, but let's actually take a look from a percentage standpoint, which is really what should matter here. That would be a 2,037% return. So we go from only a 298% return to a 2,037% return, right? And even if it doesn't go up that high, even if it only goes to like 1,065, right, we'd still make here a 541% return versus over here only a 171% return. So that's why a lot of people sometimes also go for out of the money call options, because if it does get in the money, you're going to be making way bigger returns from a percentage standpoint than in the money call options. So ultimately here, for just to kind of summarize everything we talked about here, for in the money call option, which we have right here, this is going to be more of a conservative approach, right? There's going to be less risk involved because to break even, like I mentioned, the price of the stock's not going to have to go up so much. It is going to be more expensive though, right? You will need more capital to buy these call options that are in the money. Now, when it comes to out of the money call options, like we saw, it's going to be cheaper. You're going to need a lot less money sometimes, but it's going to be a lot more riskier, right? Because like we mentioned, it's going to have to go up higher just for you to break even. However, if it does, become in the money, your returns are going to be way higher than the in the money call options. So if you're more of a conservative person, you're trying to play it safer, in the money strikes might be a better bet. If you're looking for a little bit more risk, maybe more speculation, out of the money call options might be your best bet, right? But as you can see, there are clear differences here between going in the money and out of the money. And so hopefully I've been able to clear some of the big questions that you guys might have when it comes to choosing a strike price when buying calls. So if you guys have any questions about anything I just talked about, feel free to leave them in the comments section below. Check out the Discord, link to it in the description below. Hope you enjoyed the video. Let me know what you guys think. And I will see you guys next time.